As economies of countries are more connected to each other than the past, an economy of a country can be affected by another easily. Especially monetary policies of developed countries have an obvious impact on the emerging ones. Particularly, the policies of Fed have always been at the top regarding this issue. As an example, Bevilacqua and Necchio mentions that, in 2013, markets reacted quickly to the situation that the Fed might stop buying government securities, and investors' avoidance of risky assets led to currency depreciations in emerging economies, especially in the weaker ones. Another issue that must be mentioned is that the effective federal funds rate has kept close to zero from the global crisis to 2015. In the mentioned time, Fed applied unusual monetary policies. For example, it bought long-term assets and operated communication for the expectations about coming interest rate policy. Then, with the new policy, Fed started to increase its policy rate step by step until the COVID-19 broke out. In regards of the situation, it is understood that Fed used the close zero interest rate policy to stimulate the economy. However, the decision of tapering asset purchases and increasing the EFFR in 2015 had a strong negative effect on emerging economies. Even though the case has shown negativity, effects in each developing country were different. Eichen Green and Gupta states that the markets which has faced with sharpest effects were the ones that authorized the real exchange rate to increase and the current account deficit to expand in the previous period of quantitative easing. Maintenance was not protected by the better basics such as the public debt, the budget deficit, the rate of economic growth, and the level of reserves. The size of a country's financial market was a more key indicator of the differential impact. Countries with larger markets saw higher pressure on their currency, foreign reserves, and equity prices. It is considered as investors getting their portfolios more stabilized when having a relatively large and liquid financial market is the case for the target country. For example, from March to December in 2015, depreciation of the exchange rate was around 6% in Philippines and Indonesia. However, it was nearly 24% in Russia and Brazil. So, the structure of the chosen market has importance regarding the effect of Fed. As it is known that 2008 financial crisis led to series of economic problems, the response to the crisis was aggressive in the summer of 2007. For getting out of recession, Fed immediately decreased the policy rate from above 5% to near zero levels to boost the economy. However, since the interest cannot be set below zero, Fed started to use communication as another tool to stimulate the economy. To bypass the limitation imposed by the zero bound, the Federal Reserve undertook unconventional monetary policy measures to try to lower long-term rates, shape expectations about future policy rates, and provide additional support to the economy. In particular, these measures included purchases of assets and active use of communication. As a result, real interest rate fell below 2% in the next years. Inflation was in a desired position as the target inflation of Fed is 2%. U.S. economy continued to grow due to this reconstruction policy of Fed after 2008. The strongest argument that explains why Fed started to raise policy rate in 2015, after nearly a decade, was that there was no need to boost the economy anymore. As it is known that Fed's desired position is low and stable inflation and low unemployment rate, the unemployment rate was 5%, which is half of the rate in 2009. The underlying reason was again protecting the economy from inflation. Reactions about the lift-off policy was positive in the Wall Street since bank prime loan rates substantially depends on policy rate, as it is described in the chart above. Expectations about the stock market should have been negative since the cost of borrowing rises due to the higher interest. Companies like Microsoft Corporation, Hershey, Caterpillar, and Johnson & Johnson have all, at one point, warned about the impact of the rising dollar on their profitability. S&P 500 index decreased in the next years. However, Nasdaq 100 index was nearly 2 times higher in 2019 than it was in 2015. After COVID-19 broke out, US faced with the highest level of unemployment in its history with nearly 15% in April 2020. Fed's reaction was again aggressive as it was in 2008. The federal funds rate was immediately brought to near zero level. Lower rates somewhat reduced the burden on most companies. The impact was obvious in the stock market. Nasdaq 100 index started to increase in March just after it decreased nearly 26% in February. However, high inflation resulting from overspending started to become a problem as it was nearly 7% in the December 2021. As it is seen in the graphs, both M1 and M2 increased sharply in this period. On November 30, 2021, the chairman of Federal Reserve, Jerome Powell, announced that they will start to taper their bond purchases and may increase the federal funds rate. Since unemployment was nearly 4% in December 2021, it is no longer a problem for us economy, but inflation is. It is expected that Fed will increase the policy rate in the coming years for standing against inflation. As the demand on emerging market bonds decreases when Fed stop purchasing, one fact that caused sharper fluctuations than normal in these markets is risk. An increase in the risk-free interest rate affects the risky rate more than the percentage change in risk-free rate. This mathematically suggests that the situation leads to deeper fluctuations to occur and the ability to repay loans decrease for emerging markets. In 2013 May, discussions about the future of security purchases were on the Fed agenda, and the chairman Bernanke's testimony about tapering was echoed. Even if the policy was not applied rapidly, it had a sharp impact on emerging markets. The situation shows that not only the applied monetary policy but also the predictions about the future can make the markets manipulated. Green and Gupta mention that some alarmist expectations were stated in regards the situation could cause a crisis like in Asia in 1998 or in Mexico in 1994. However, it reflected in exchange rates, stock markets and reserves in the negative sense. Except China, all countries faced a depreciation in their currencies. These were the countries that suffered the most, as the response in these countries was selling some of their reserves to stand against depreciation. Again, except China, they all had negative change in their reserves. This situation actually shows that the Fed uses communication as an economic tool in addition to policy rate. In this model of monetary tool, shaping the expectations about future is considered that it has an essential impact on longer period. However, this kind of a use of communication can cause political concerns. As most of the developing economies has dollar-dependent markets, unpredictable Fed announcements, which can be called manipulation, can keep the political tension high. Steele mentions that lots of leaders criticized the behavior of Fed, especially the chairman of Indian Central Bank said that the Fed and others in the rich world can't just wash their hands off and say, "We'll do what we need to and you do the adjustment." It is obvious that the monetary policies of Fed have overall impact on developing world. However, some countries are affected hardly and some are not. When the president of Fed, Janet Yellen, announced that the Fed would not have a tool to fight recession if they keep the policy rate close to zero, she also evaluated that it is a positive development for emerging countries, but the outflow of capital from countries is a negative effect. Most affected countries in this period were the most dollar-sensitive ones. The current account balance and reserve sufficiency are the key terms in regards being dollar-sensitive. Countries with the higher current account deficit in the previous period were hurt the most. Especially Brazil, Turkey, South Africa, India and Argentina let their current account deficit to rise. However, China, Malaysia, South Korea, Vietnam and Philippines had mostly current account surpluses in between 2009 and 2015. Even if the stock markets, In those had current account surpluses, had fluctuations. In the long term their currencies did not depreciate sharply. However, Brazilian real had nearly 40% depreciated in the period after Fed policy rate liftoff, and so others. When the underlying reasons mentioned turn into a major unsolvable situation in a country, it is not unpredictable to see a decline in GDP and also per capita GDP. Countries with the decreasing GDPs are mostly the ones which have decreasing value of their currencies and current account deficits. Russia, Turkey, South Africa and Argentina had decreased growth rate in the 2015-19 period. Malaysia, Vietnam, Philippines, China and also India had increasing GDP per capita. Despite the fact that having current account deficit before liftoff, India did not have sharp fluctuations due to the magnitude of its economy. However, most of the country's GDP PPP did not decrease relatively, but the overall growth rates were decreased in the period. This kind of a nominal base decline shows that the effects are more tolerable in the longer time. Besides, high currency depreciations can change trade trends to rise net exports, which can make the budget deficits of these countries less vulnerable in the long run. However, when negative specific conditions of some of emerging countries and the Fed pressure comes together, it leads to financial crisis in these countries. As the Fed's monetary policy may be comparable to domino effect, but in a way that the fall of a large stone shakes the table, and the stronger ones get shaken less. The most traditional and useful economic lever for the Fed is policy rate, as the reason for the usage of this lever may be for stimulating the economy or balancing the unemployment rate and the inflation. Yet, when this kind of a lever cannot be pushed more, use of communication enters the game as another lever. As the rise of the traditional lever has a downward effect on emerging markets, the new one may cause political temperature to get high, as it may be called speculation or manipulation in the emerging side. Having greater current account deficits and large trade within the dependency of dollar makes some of emerging markets dollar sensitive, in which a negative perspective seen by foreign investors increase the fact of risk. Moreover, political conflicts, not only the external ones but also the unorthodox domestic uncertainty, specifies whether a market is affected deeply or surely. Anyhow, this kind of domino effect eventually causes small or high declines in regards to the growth and the wealth of middle-income world, which may affect the income distribution of the world. As the economies of countries tightly bound to each other and the world economy is in a fragile position, policymakers should effectively process their decisions.